You just spent $300 million on a cluster of office buildings that don't rent to just anyone. Not a single skyscraper, not a random business park, a sprawling campus built specifically to house technology companies, startups, and research labs under one master-planned property. And somehow, this carefully curated real estate is one of the most sought-after commercial assets in the entire economy. Welcome to the strategic world of owning a tech park, because today, you own a property that fast-growing companies are desperate to plant their flag inside. Every single lease, every single tenant. Let's talk about what you actually purchased. A tech park isn't really an office building business. It's a curated ecosystem of buildings designed to attract and retain innovation-focused companies. Somewhere out there, startups, established tech firms, and research institutions all need specialized space with modern infrastructure and proximity to talent. Maybe it's a growing software company that needs flexible office space near a major university. Maybe it's a biotech firm requiring specialized lab infrastructure alongside standard office amenities. Your park is the physical home for innovation, and that kind of specialized space commands serious rental premiums. Tech parks generally fall into two categories: single-tenant campuses built for one major corporation, and multi-tenant parks that lease space to dozens of different companies simultaneously. You've landed a multi-tenant park, and that changes your entire leasing strategy completely. Unlike a single-tenant campus dependent on one company's fortunes, you diversify risk across dozens of tenants ranging from tiny startups to established firms. Historically, tech parks trace back to the mid-20th century, when regions like Silicon Valley pioneered the idea of clustering technology companies near research universities. The model barely changed at its core. Build modern space, cluster innovative companies together, let proximity and talent density do the rest. So how does buying a tech park actually work? You don't browse a standard commercial real estate listing for a property this specialized. These deals happen through commercial real estate investment funds, institutional real estate brokers, or direct negotiations with developers looking to sell completed campus properties. Your $300 million price tag is based heavily on your existing tenant leases and the overall occupancy rate across your buildings. If your park sits at 95% occupancy instead of 70%, that difference alone can significantly increase what buyers are willing to pay. Before you sign anything, you had to survive months of financial and structural due diligence. Engineers inspected every building's electrical, HVAC, and fiber infrastructure to confirm it meets modern technology tenant standards. Real estate analysts studied tenant industries and lease terms to confirm your rental income would remain stable across economic cycles. Lawyers reviewed every lease agreement to check rent escalation clauses, renewal options, and tenant improvement obligations. And regulators had to approve the transfer, because zoning, environmental compliance, and infrastructure permits are heavily scrutinized for a property this size. Financing a purchase this size rarely comes from one source. You likely combined your own capital, commercial mortgage financing, and specialized institutional real estate debt, secured against future rental income. That's the fascinating part of tech park ownership. Your tenants often grow rapidly, meaning your rental income can expand significantly without you doing anything at all. Your first morning as the owner starts before most tenant employees even arrive. Property management crews are already checking building systems, common areas, and shared amenity spaces across the campus. You walk the grounds, watching employees from dozens of different companies stream into buildings scattered across the property. Every square foot of leased space generates steady rental income, whether that tenant company is thriving or quietly struggling. Every successful tenant that grows and expands tends to lease additional space directly from you instead of relocating elsewhere. Multiply that by dozens of tenants across hundreds of thousands of square feet, and the revenue stability becomes obvious very quickly. You check the property management office, where systems track occupancy rates, lease expirations, and building performance in real time. This isn't just real estate. It's an ecosystem operation, tracking every tenant, every lease dollar, every amenity usage around the clock. Now let's follow the money, because this is where tech park economics get genuinely fascinating. Your revenue comes from base rent across dozens of leases, but the lease structures vary significantly by tenant size and type. Small startup tenants typically sign shorter, more flexible leases at somewhat higher per square foot rates. Large established tenants sign longer leases at lower per square foot rates, but commit to enormous total square footage. Many leases also include annual rent escalation clauses that steadily increase your income without requiring new negotiations. Some parks add shared amenities like conference centers, fitness facilities, and cafes to generate additional ancillary revenue. On a well-performing tech park, annual revenue can range from $20 million to well over $100 million depending on size and occupancy. Over time, that's an enormous, diversified income stream flowing in from dozens of growing companies simultaneously. Your expenses are spread across several major categories. Property maintenance costs cover everything from building systems to landscaping across an enormous physical footprint. Property taxes are substantial, since tech parks occupy some of the most desirable commercial land in any given region. Marketing and leasing costs cover attracting new tenants and negotiating renewals as leases naturally expire over time. Infrastructure upgrade costs are ongoing, since maintaining cutting-edge fiber and power capacity requires continuous reinvestment. Many well-run tech parks operate with profit margins between 30 and 50%, strong numbers for a real estate asset this specialized. Of course, nothing this valuable comes without serious headaches. Problem number 1. Tenant concentration risk. If several major tenants decide not to renew simultaneously, your occupancy and revenue can drop sharply and unexpectedly. Problem number 2. Remote work trends. Shifting workplace habits toward remote and hybrid arrangements can reduce overall demand for traditional office space. Problem number 3. Tech sector volatility. Since your tenant base skews heavily toward technology companies, industry downturns can hit your occupancy harder than diversified properties. Problem number 4. Infrastructure obsolescence. Technology tenants demand cutting-edge infrastructure, meaning your buildings require constant upgrades to remain competitive. Problem number 5. Competing developments. New tech parks built nearby with more modern amenities can lure away tenants when their leases eventually expire. And problem number 6, maybe the scariest one, economic sensitivity. Venture funding slowdowns and broader economic downturns can shrink your tenant base as startups fail or scale back operations. That means even a historically thriving park can, in theory, face serious vacancy challenges if the broader tech industry cools significantly. Some parks generate additional revenue by offering flexible co-working spaces alongside traditional leased offices for smaller tenants. Others partner with local universities to host incubator programs that eventually convert into long-term paying tenants. So, is owning a tech park actually worth it? Financially, few real estate assets offer this combination of genuine tenant growth potential and diversified risk across an entire ecosystem. Innovation and technology development continue driving economic growth, regardless of short-term market fluctuations. Companies continue clustering together for talent access, collaboration, and prestige regardless of remote work trends. Your park captures a slice of the innovation economy itself, because as long as companies need physical space to build the future, someone needs to provide that campus. But you're not just buying buildings, you're buying exposure to tenant concentration, evolving workplace trends, and constant infrastructure reinvestment all at once. The smartest owners treat their park less like a passive real estate investment and more like an actively curated innovation ecosystem requiring constant tenant relationship management. Keep your infrastructure cutting edge, keep your tenant mix diversified across company sizes, and keep your amenities genuinely valuable to a modern workforce. Do that, and your $300 million tech park could generate strong, growing returns for decades, remaining a genuine innovation hub the entire time. So congratulations, you didn't just buy a tech park. You bought a stage for the future itself. One lease, one startup, and one breakthrough at a time.